Welcome back. We are discussing what to expect from the credit policy with Suman Bery of NCAER, Rajeev Malik of Macquarie and Srinivasan Varadarajan of Axis Bank. Dr. Bery, given this kind of, an economic growth pull, 8 to 8.5% seems to be the average growth expectations on our poll as well, and credit growth of 20 to 24%. Given all this, isn't there a recipe for inflation already? What is your expectation of inflation performance in the current year?
I think the big sort of joker in the pack, if you will, is what is going to happen on the one hand to commodity prices globally, and on the other hand to the economies of the advanced countries. Because let's remember what happened in August 2008, July-August 2008. On the one hand, you had oil at $147 in the middle of an OECD crisis. I mean, because the crisis for the OECD countries had begun in August 2007. It reached our shores only with Lehman in September 2008. Everybody was asking the RBI to tighten at that time, which it did, at exactly the wrong moment, because then the world economy fell off the cliff. Given what's happening, Lata, in Europe, with Greece, with the euro, given what we see about the diffidence of central banks in the US, the UK, in very sort of slowly withdrawing stimulus, the world economy is still not back in shape. And so I think to overreact to supply-side pressures coming from the commodity markets, I think is a mistake, okay? Because they themselves are deflationary. Let us not be unmindful of the two deflationary forces on the economy. Firstly, net exports are deflationary, and in nominal terms, I'm sorry to get technical, particularly deflationary if oil prices are going to be rising. Secondly, we've got, at least in theory, or at least in promise, a fiscal consolidation. So two, important elements of aggregate demand are heading the wrong way, the fiscal and net exports. So that basically leaves private consumption and private capital formation to pick up the slack if we want 8.5. I don't think 8.5 is a done deal on the demand side.
Okay. Well, Rajeev, let me toss the same question to you. I would still have a lot of worries on inflation. I grant Dr. Bery's point that, there is a slack in the global economy in terms of capacity. But, there is also a potent combination in India. We could have high inflation even if there is excess capacity abroad in several areas. We have a combination of a fairly decent growth rate of 8.5%, possibly 8.5%, plus a credit growth which could be as high as 24%, and a lot of cash sloshing around in the system, 16.7 M3 in our country right now when credit growth has not even picked up, and a fair amount of liquidity sloshing out globally. Could inflation be a demon which will spoil the party in FY11?
Well, could it? Yes. Is it going to? I still don't think so. We again come back that it's one thing to say that Europe has problems. I think US is actually more likely to surprise on the upside than on the downside. But fundamentally, the issue with India, again, is all of us try to think that RBI has a solution to managing the inflation problem, whereas in India's case, a big share is actually driven by supply-side factors, and the government, bless our souls, just is never able to do anything about it. At some point, no matter how supply-driven inflation is, it has to feed through to broader side. I mean, anyone who's working, no matter how unskilled, will realize that he's paying more for food, which incidentally is government's own active policy. So, you can't have this situation that, yes, a lot of the input prices are going up owing to a combination of strong demand and supply-side factors, but by the way, RBI should not do a whole lot of stuff. It's tactical as to how much of a control RBI can have, if it indicates a 5 or 6% inflation forecast for next year.
Yeah. Okay, I take your point that even if the policy rates are moved fairly high, the Reserve Bank doesn't have too much of a handle on inflation. But at 3.5, it's not even making an effort. It's outside the realm of even relevance.
I think just a quick one. Don't forget that, we often talk about government borrowing that government borrowing is a lot of spending going into the economy, right? So there has to be a bit of a balance. So it is right that policy rates themselves are actually quite low, but see what kind of transmission that has actually taken in terms of actual lending rates. I mean, until the January meeting, a whole host of people were still talking about RBI should not be doing anything at all.
Absolutely. Well, Rajeev, running out of time, but what do you think they will manage and they are likely to do in terms of policy action for FY11 as a whole?
Well, my sense is because I consider 25 on rates and 25 to 50 on CRR a more potent combination than 50 on rates, that's what they should do on April 20th. For rest of the year, I do think at the reverse repo level, they have to get to 4.5 by December or January. 4 quarter by December or by March. And thereafter, don't forget, RBI will be tightening policy in FY12 as well. Everyone seems to think that, it'll be done with that. No. It's just that by December, we should be there at a very crude, neutral policy rate, so to speak. One really can't talk about a neutral CRR because, liquidity flows, intervention in FX could distort that.
Okay. Well, that exactly is the question I wanted to come to you. Will the RBI be forced not to, raise its reverse repo or its policy rates much simply because of this huge tidal wave of flows that looks, likely to hit Indian shores? Let me give you just one example. Short-term credit flows, the one that is most sensitive to interest rate differential, was minus 4.2 billion in the Lehman quarter, December 2008 quarter. It fell to minus 5.4 billion, which means outflows in the Jan-March of 2009. Again, minus 1.5 billion in April-June 2009. It becomes a small plus of 800 million in July-September, but it has become a flood of 3.2 billion flows in short-term credit in October, December, the last numbers which we have. So interest rate differential and the possibility of a huge amount of flows hitting because the currency is appreciating, would that stay the RBI's hand, Rajeev?
I think it should. If you see how attractive the carry is as far as some of the Indian rupee instruments are offering, I think it's almost a one-way bet. Now, this is going to lead to what is going to be, I think, the next battleground, so to speak. And don't forget, RBI dipping its toes in the FX market for the first time after several months is indicating, even an F1 driver, when he approaches a turn, has to slow down. So we may not be there yet, but we are fast approaching that point. And they'll have to think about how do they deal with managing capital inflows, rupee appreciation, and don't forget, unlike during Reddy's time, there's a sizable divestment program which can't even, go through successfully without foreign participation.
Srini, not much appetite even for government bonds, and if MSS also comes in, then we would have a problem. But my question to you is merely as a banker. If the RBI were to raise, go by the consensus, 25 on all the three instruments in April itself, what do you think will be the bankers' reaction? Do you see rise in lending rates?
I think if it's just 25 basis points, I would be surprised if rates are immediately raised in April itself. I think people would wait to see what happens over the course of the quarter, look at how credit growth pans out, look at overall liquidity, and then I think somewhere as we go into the next quarter review is when I think banks will prepare to raise rates if things continue to be the same way as it is right now in terms of fundamentals being strong and rate outlook continuing to remain bearish.
Point taken. Suman Bery, Rajeev, Malik, Srinivasan, Varadarajan, thank you very much for joining us. What I get from the experts is that they don't see too much of a problem. They are largely sanguine that inflation is not going to be such a beast that I fear it could be. And on growth as well, 8.5% is what our poll is throwing up. Our experts are not really disagreeing. And Srini is coming with the biggest consolation that even if there is a 25 basis point hike in all the policy rates and CRR, you're not going to see money getting expensive just yet. It might take a little while longer. So perhaps you and I as borrowers or as depositors don't have much to worry just yet. That's the expert take now. But I, for one, would really fear inflation.